What's going on, guys? Welcome back to the channel. In this video here, we're doing a stock analysis on Intuit Inc. Now, that's ticker symbol INTU. It's requested by, hopefully I'm saying this properly, Vahid. Now, this is a company I actually wanted to get to. So, you know what, Vahid, you got good taste. Let's take a look at Intuit. We're going to load this up in the stock research tool here, folks. So what Intuit is, if you haven't heard of this business, they run a lot of personal finance apps from QuickBooks to TurboTax to Credit Karma. So they can manage your net worth, your budgets, and obviously your taxes. So this is a very interesting business. $122 billion market cap. It hit extremely high. This is it's very pricey. I have $434 and a 52-week range. We hit a high of $716. Is that real? Is that right? That is absolutely insane. And it hit a low of 339.36. Okay, interesting. So what we're going to do here, folks, we're going to look at our three categories. We have our company metrics, which compares the last 5 years to the trailing 12 months, our financial valuations, which grades the income statements, the balance sheets, and the cash flow statements. And finally, and last but not least, probably the most important part of my software here is our price analysis section, which will give us the intrinsic value of this business. So stay tuned for that. So with Intuit, in our company metrics category, what we're trying to look here, folks, is some discrepancies, some differences, some improvements, if you will. Our PE ratio has been decreasing, as we can clearly see, by a mere 0.99, right? From 50 all the way down to 49, folks. So it's still astronomically high. We're not a huge fan of that. But our EPS is up. So we like seeing that. Our EPS is from 5.83 to 8.92. Great. Our return on equity is down, not looking too hot, and our profit margin is still in the same realm. We do pay out a small dividend, a little baby, 0.63%, and that equates to a $646 million payout. Now, it's not bad. Our average free cash flow being at $2.2 billion, that means we can cover those dividends no problem. It is somewhat, it's not a bad payout, I gotta say. I'm not gonna complain. But our current free cash flow currently is at $3 billion, so that's positive. That's actually really good. Return on invested capital took a little bit of a hit. We have a low Piotrowski score, and our Almond Z score though is pretty high. 6.41 actually is a decent score. We want to see this number over 3, and we have that, like, no problem. That's actually comforting to know. Overall, in the company metrics category here with Intuit, it's been pretty consistent over the 5-year averages. Some decreases in, our return on invested capital is probably the one major thing that we're losing out on here, but it's not the worst. So flipping it over to the financial evaluations, folks, what we do here is look at our cash flow statements, our income statements, and balance sheets. Grading this company out of 10, we're currently sitting at 8. That is fairly high. Now, they're doing a lot of things right, but a couple of things wrong. 2 of those things are our PE 5-year average sitting at 50.99. We want to see companies at a PE ratio that's 22.5 or lower. We don't have that. It's pretty much double that. So not great. And we are slightly being diluted with shares. If you take a look here, pretty much 3.5% of shares have been increased over the last 5 years. So you are owning less of this business, folks. We want to see this number going down. However, they are doing a lot of things right. And what are they doing right? They have a strong current ratio for the most part, 1.63. That means they have enough assets on hand to cover their liabilities. So that's very important. Return on equity is high, sitting at 44%. EPS growth is up. Debt to equity is low, sitting at 24%, where we want to see this number underneath 50%. That's imperative, folks. What that means, though, is that they are growing this business through equity and not through debt. The less debt we take on, folks, the better. Just like in your own personal life, if you keep racking up your credit card debt and you're living card to card, check to check, it's not a good time. We want to be building other forms of assets to pay for stuff. Now, our 5-year net income growth is up, so that's important. Our free cash flow is up, our revenue is up, and our return on invested capital is extremely high, sitting at 41%. This is great. The only discrepancies I have is this PE ratio and the share dilution. The share dilution, I can't forgive as much. I want to see this number going down, but with a PE ratio, ideally, if the company can justify a high growth, they may be able to adjust this PE ratio. However, most times that doesn't seem to happen. So it's had an incredible run up, as we can clearly see here. And where did it start coming down? Pretty much 2021 was end of 2021 was extremely high, and then it just started to just come down a little bit. Come down a lot, rather. But that's good. That's good for us potential investors, because now we're going to find out if this is a price that we can buy in at, if it's worth this price, or if we have to wait for it to go lower. So what we're going to do, folks, we're going to go into a price analysis here. We'll do a 10-year evaluation. I'm going to fill out all of these boxes, and we'll explain what I did. So stay tuned. So folks, before we jump into the price analysis section, if you're enjoying the video so far, hit that like button, hit the subscribe button. If you want to see a company evaluated, write it down in the comment section down below. I look at all the comments, and I love the feedback, and I love the community that we're trying to build here. So with Intuit, here's what I'm doing. If you're new to the channel, I like to try to stay as conservative as possible to try to give myself the most margin of safety. So with our revenue growth, you might think I'm crazy, but I'm going 10, 11, and 12. I know that they show 10 in the 10-year mark, and 15 and 25. It's a fast growing business. However, I'm giving it a haircut for my margin of safety. In case they beat these numbers, it works out in my favor. Profit margin, I'm doing pretty much consistent with what we've been showing. So I did 19, 20, and 21. Free cash flow, same thing, doing 29, 30, and 31 based off the numerics that they've given us. Now with our price to free cash flow and PE ratio, I've discounted it a lot. 40 is way too high, 49 is way too high. So I did 14, 16, and 18. 14, 16, and 18 again. And desired return, I'm doing 13%. We're going to click calculate. I'm going to see what a fair price to pay for this business would be. Current price, $434. We'll see what that comes out to be. I won't be surprised if it comes out to be a little bit overvalued. Yes, and I was right. So our average calculation comes out to be $313, and that's evident around here with our moderate average. On the high side, we do have a 384. So here's the thing with Intuit. It's a solid company. It's got great financials. However, we're being slightly diluted, and it's just overpriced. I use their app Mint pretty much on the daily. I use it to track a lot of my budgets, my net worth, and stuff like that, as well as I use Credit Karma every now and then just to keep a rough look at my credit score. You know, it just makes me feel good. But they have a lot of great applications. They have a lot of great things for small businesses. Like QuickBooks is extremely popular, and I was about to use that for my own personal business, but I hired an accountant to take care of that. But they offer a lot of great, if you are an entrepreneur, if you're self-employed, they pretty much have a one-stop shop for everything. And what we've seen now with this whole pandemic, that a lot of these small businesses have been erupting. That is why I think a lot of this growth to Intuit has been surged because of this pandemic. A lot of these mom and pop shops have been axed out, but then you have a lot of these small businesses and entrepreneurs that have taken on these side hustles, grow and use their platform. I don't see them slowing down. And then the foreseeable future, I think they have a great niche, but as it currently stands, from a price perspective, as we see here, it is a little bit overvalued. So what I'm going to do is I'm going to put a little bit of a marker. I'll put this on a watch list and wait for it to go south of the 330 mark. Actually, you know what? I'm going to wait for it to go south of the 315 mark. If it gets below this moderate average, it might be something to look further into. But as it stands now, slightly overpriced. If you like the video, folks, hit that like button, hit that subscribe button, share it with a friend that's looking to get analysis of this business if they are trying to invest in this. This is the process I'm trying to teach here, and we only do fundamental analysis. We're no BS channel. So if you enjoyed the video, do those 3 things, and I will see you in the next one. Write down a stock that you want to see evaluated here. This software will be available to you, my subscribers and viewers, and when it's out, you'll be the first to know. And there's a lot more tools along the way, folks, so check it out. We got this. We also have, if you want to see things a little bit more visually, we have all this charts section here. We have also the income statements, and we have the cash flow statements and balance sheets as I discussed. So there's a great piece of software here that'll help you analyze these businesses within an instant, so you don't want to miss out on that. Anyways, that's the video. Thank you so much for watching. I will see you in the next one.